All right, we're going to finish up with year three for this company. These are pretty unrealistic because there are thousands and thousands of these transactions throughout the year. They're just trying to illustrate it. Not the method I would have used, but I didn't get paid to write a textbook either. But in this instance, all we're going to do is look at the accounts receivable. That's the main point of doing year three. And year one, everything was cash. Year two, what we pointed out was the company bought stuff and didn't pay cash for it. They used accounts payable. And in this third year, what we're going to demonstrate is making a sale using accounts receivable. Accounts receivable is when you sell to your customer, but they don't have to pay cash, you take an IOU. Accounts payable is when you buy something and give an IOU. Accounts receivable is when you sell something and take an IOU instead of cash. Eventually you settle up, but not right away. All right, so JPS sold on account. Sold on account means that we took an accounts receivable, we sold for credit. We let somebody buy on the credit card something with a list price of $8,500. Instead of recording $8,500 in cash, we'd record $8,500 as accounts receivable. It's still a sale, so revenue would be $8,500. All right, so retained earnings is $8,500. We ain't got the cash yet, but we're going to get the cash. It's assumed that you're going to get the cash. All right, so our balance sheet still balances. And the second part of this, 1B, is the stuff we sold cost us $4,000. It was $4,000 of our remaining $4,100 of inventory. So that comes out of inventory, comes out of retained earnings, and it's recorded as an expense. Okay? So we sold $4,000 worth of crap for $8,500. We just hadn't gotten paid yet. And then one of those customers from event 1A decided they didn't like the color of the shirts that we sold them. And they bring back, and it was list price of $1,000, but it actually cost us $450. Okay, we'll take $1,000 back out of accounts receivable, which means that sales weren't $8,500. They were actually $1,000 less. And so we back that back out of here, out of our retained earnings, and add them back to inventory. Okay, we took out $4,000. We put the $450 back in here. We put the $450 back in here. And put the $450 back in here. Now all that means is that $4,000 here really wasn't $4,000, it was $3,550. Okay, but remember we go through multiple steps in here because the accountants want to keep track of everything, and that's good because we want to sort of have an idea of how much we sell that we actually didn't sell that has to get returned. Okay, so far so good. And then item number 3, JPS collects the balance the accounts generated, which was $8,500 less than $1,000 where somebody returned their stuff. So it's $7,500. Let's keep it simple. They did it after the discount period because we don't want to screw around with the discounts because that would just take 2 entries. All right, so cash goes up by $7,500. The accounts receivable goes down by $7,500. All right, but all we're doing is taking the money that was in accounts receivable and shifting it over into the cash account. So that's the only thing that happened there. Our total assets still $33,590. Our total liabilities and equity $33,590. And those have gone up by $3,950 over the course of the year. Retained earnings had been 10,640 at the beginning of the year, add 3950 to that, and everything still balances out. All right, so the only thing that happened here, the only cash activity for the cash flow statement was the $7,500 we collected, and that's an operating activity. Operating activity because it is activity in the current assets, or the working capital assets, accounts receivable and inventory. All right, so now we've actually collected the stuff that we reported in the income statement. All right, so everything still balances and we are good to go with the JPS example.